Well, welcome to the Plan Your Federal Retirement Podcast. I'm your host, Micah Shalansky, and with me, I got a special guest, but an awesome advisor, my father, Floyd Shalansky. Hey, Pops, how's it going?
Doing great, son. It's winter's coming to Alaska.
It is quickly coming to Alaska. I was hiking in snow a few weeks ago, then it all kind of went away, but it's starting to come back, isn't it?
Yeah, even driving in from the house this morning, had snow flurries.
Oh, all the joys. It went from fall to winter in a quickness. Well, speaking of things that are going to happen in a quickness, year end is approaching us. We got the end of October here. And before we turn around, this year is going to be wrapped up and it's going to be time to looking at your income taxes. So one of the things we're doing right now with a lot of our clients is we're talking about tax planning. And Pops, I thought it'd be a great idea for us to jump on here. Actually, it was your idea to talk about the tax planning, which I thought was great. What are things that we need to look at year end to make sure people are on track for taxes, and what things can we help do to help control that tax bracket now and in the future?
Mike, a great question, and I think it's time to do that. So many times people wait until December 25th or right after Christmas to do their tax planning, and there's not a whole lot we can do. So as I'm meeting with my federal clients right now, we're projecting year-end income, and we're starting just to run a tax calculation. And it's amazing how many people I find that have not maxed out their TSP.
Yeah, doing that year-end review is really good right now, right? A lot of things can go wrong throughout the year that we can miss. I'll tell you one thing, whether it's you're actively employed or you're retired, I've seen your withholdings get changed, where I've had a retiree that withholdings all of a sudden got stopped at OPM or reduced. I've had federal employees that are active, their withholdings got changed as well. They go on about every single day life, their paycheck changes, but no one's really paying attention to that net deposit coming in every 2 weeks. They think it's fine. And then at the end of the year, they get their tax bill. They're like, holy crap, how do I owe so much in taxes? Nothing has changed. And we go back and look at it, and it's because they didn't pay enough in, right? So now is a good time to be reviewing all those things.
Micah, you're 100% correct. And how about someone that turned 70 and started Social Security? They don't get taxes withheld. You have to submit another form for that. Surprise, April 15th.
Yeah, all of your withholdings, right? It's all going to be different. So let's talk about this just a little bit and some things that we can do. Is number one, I would definitely say, look at running a tax projection. And for us, that's get all of your sources of income together and look at a year-to-date statement and how much have you been paid gross, which is going to be taxable, and then how much have you paid into the IRS in each one of those sources?
100%. And you have to remember that the IRS pays us on a 12-month period of time. And then you've got to supplement by the quarterlies, which really aren't quarterlies, right? Because you've got that June crazy one and that August crazy one that you got to build up. If not, you have subject to some penalties.
Yeah, and making those estimated tax payments. So there's a couple things you can do. Now, if you're coming at year end and you are looking at this and you still owe money, a couple things to think about is number one is, have you max funded your TSP account? There is still time to increase your withholdings and put more into your TSP, whether that's the normal contribution or catch up. If you're age 50 or older this year, you can put more money in there. You cannot do it via a check. It has to be payroll deduction. So that's the reason we got to be ahead of this and can't wait till after Christmas to figure it out.
Mike, I'm doing that with 3 of my feds right now. They're short with about 10 grand. So we took how many pay periods are left for the year and dividing it out and increase it just a little bit, because OPM may not respond quickly to start the deductions.
Yeah, that's such a great point to be thinking about. Another thing is going to be your HSA contributions, your health savings accounts. Now, open season is upon us. Well, quickly upon us, I should say. It's coming up very soon. And so maybe you've done it, maybe you haven't. If you're in an HSA for this year, so you're in a high deductible account that's HSA eligible for health savings account, you can put more money away pre-tax and take it out tax-free. So I'd be looking at those contributions. Have we put enough money in there? Now, if we're not eligible for one, then I'd be looking at 2024 during this open season. Can I make a change in my plan so in 2024 I'm eligible for that HSA?
You know, Micah, that's all part of that planning side of it, right? You have a lot of things going on in your life that you need a normal deductible, or you've been pretty healthy and maybe, and not picking on kids, but maybe the kids are not out of the house. So now I can have a high deductible plan. and then start maximizing putting extra money into that up to the max every year and accumulate it year after year after year up until you turn 65.
Yeah, but more money inside of it, which is always a fantastic idea. That money can grow for you tax-free in an HSA. You can actually invest it through TD, which is now Schwab. You can invest that money and have it continue to grow for you, which is just fantastic. So these are really important things that we should be looking at and saying, how do you plan for it?
It's not only that, Micah, but it's talking about, are you selling a piece of property? Do you have some capital gains you have to deal with? Can we delay something into next year because you're going to retire and the income's going down? It's so important to look at all aspects of your income and your expenses, as well as what you own if you're going to buy or sell something in the upcoming year.
Ooh, all right. So you're getting a little bit of planning distinction between my dad and I. So there's that one aspect. Should you defer selling something? I'm going to take the other angle on it and say, should you accelerate on selling something? Because we know what the capital gains laws are. And in a couple of years, our current tax laws expire. At the end of 2025, which is quickly approaching, our current tax laws expire. They get repealed and go to a higher amount. Now, what's going to happen with taxes? Who's going to know the code? I don't know. I'm just looking at the current tax law as we know it today. But Pops, to your point, these are things you should look at and at least make an educated and informed decision.
Oh, without a doubt. I was talking to a client yesterday, and he said, I got this lot. I think I'm going to sell it. And I go through his income, and his taxable income is going to be under $22,000 this year. And I go, well, I would do it this year because under $22,000, your long-term capital gains rate is 0. And he goes, I didn't know that. So, yeah.
Yeah, so taking advantage of things like that is just a fantastic idea. Yeah, so all of those sources, et cetera. Then looking a little bit into next year as well with that one too, right? What can we set up in 2024, whether that's maybe in your FSA, a flexible spending account? Do you want to increase your contribution to that? Do you want to set that account up, et cetera? Can't do anything with this year with an FSA, but for 2024, you absolutely could.
Micah, and so many times we see people that have the FSA and says, well, let's use it or lose it, so I don't want to put any money in it. And I go, well, if you're not on a high deductible plan, why don't you put money in there? Do you need to replace your glasses? Do you need something that's not covered by the health coverage that we can pre-fund it? And it's all tax deductible.
Yes, that's the huge part of that, right? Is being that tax deductible side of it. So FSAs are great if you're going to use the money with a little bit of that kind of carry forward. Outside of the health benefits, Pops, another one to consider that we're thinking about on year end with a lot of our clients is Roth conversions. Doing that tax analysis and saying, hey, when these tax laws expire and your taxes go up in 2026, what does that mean? What tax bracket will you be in? When you retire, what tax bracket will you be in? Does it make sense to do a micro Roth conversion? So maybe not hundreds of thousands of dollars, maybe it's hundreds of dollars, maybe it's tens of thousands of dollars, but converting some of that Roth IRA, paying some taxes today on that money, but have that money grow for you tax-free.
So I'm telling people, if you do a Roth conversion, consider it like you're planting a seed, an apple tree, right? Do you want to pay taxes on the seed, or do you want to pay taxes on every time you pick an apple off the apple tree? I'm going to pay taxes on the seed because now the apples are tax-free.
It's a great point. And the seed is smaller. You're paying taxes on a smaller amount, right? And what you're betting on here is, well, regardless of what tax laws do or not, I like diversification. Same reason you don't have everything in the C fund. Same reason you don't have everything in the I fund, right? Is we want to diversify our investments. Are you diversifying your tax plan? And that's what these strategies allow you to do.
Micah, so many times we talk to people that did a great job diversifying the TSP and maybe their IRAs. But when we start talking about taxes, their eyes kind of glaze over and go, I never thought about that.
Yeah, that's really important to think about, right? How do we minimize those things to make sure you're not being doubly taxed on things, to make sure the taxes aren't dramatically increasing you in the future on all of those things? And that all comes back to it, Pops, of what you were saying, is doing a tax calculation or tax projection for the end of the year. How is that being set up that make sure that you know what your taxes are going to be?
Micah, for years, the Schedule A for W-2 workers was the best place to put money away. And we watch people pay, I remember the old adage, one of our CPAs told me, Floyd, buy a bigger house and pay higher interest because it's all deductible, right? Well, now we have limitations. Married filing jointly in 2023, you have to have excess interest and charitable contributions or property taxes. It has to see $27,700. Wow. So many times I have clients that'll walk in with stacks of paper and we do the calculations and it's under 27.7. Things have changed dramatically from that aspect. And so many times people are still remembering 3-4 tax acts later, what it used to be, not what it is today. So I strongly encourage everyone listening to the podcast, get your last year's tax return out, look at your LESs, do your tax calculations, make sure, then look at that Schedule A. How much did you pay in interest? How much you pay in property taxes? And I can't forget the Tax Act, but now we're limited to $10,000 maximum on sales tax and property taxes now, right, Micah?
Yeah, you got that SALT limitation, which is there, right? State and local taxes, which is you're limited to that $10,000. So, if you chose to live in a state with a state income tax, you got to worry about that. That would be Alaska, Florida, Texas, Washington. If you don't get the joke, those are states without a state income tax. But those are something you got to figure in. Property taxes as well, right? So, and with the increase in the standard deduction, and this next year, the standard deduction, when I look at my cheat sheet, is going to be $27,000 and change. So you got two things. You got a limitation on those SALT deductions. In addition, you got that increase in that standard deduction, which is amazing. It really allows a lot of people to get more of a deduction than they did before. But then that probably means on charitable contributions, how does that stack in? Should you use a donor advised fund? Should you use QCDs, qualified charitable distributions, right? How should you kind of mix that up because you have such that great standard deduction?
Micah, we could do a whole podcast on on alphabet soup, right? QCDs, RMDs, and so on. All right. But so many retirees don't even understand or don't even know that QCDs that are out there. And they're great, especially if you can't exceed the charitable contribution rate on the Schedule A. But again, tax planning is so important. And the thing that I look at, being a little older than my son, is in this tax planning, since 1981, I've seen tremendous tax acts change. But every time it's changed, they've given us more leeway, higher charitable contributions, higher this, that, and the other. So right now at $27,000 on the Schedule A, I think that's less than 20% of Americans are actually filing now that what we refer to the long form, taking advantage of that Schedule A. So all of a sudden they cut all these things down and make it easier to file taxes. What happens when they start raising the tax rate? And the sunset provision that you talked about a little bit earlier that takes place in 25, I believe, that we revert backwards to the old tax brackets?
I think that's such a great question, Pops. And this is why you need to know what your tax plan is today. This is why you need to kind of think about this, not just today, but why we like to run a 10-year tax projection with our clients is it's not the taxes today I'm worried about, it's the taxes in 10-year. Taxes is the largest expense you will have in retirement, probably even greater than healthcare, especially federal employees, right? You have fantastic health insurance. So it's the largest expense. How are you planning on saving for it or getting it reduced?
It's so important. And, so many times when people talk to us, Micah, my comments are they're interested in the TSP. Do I have the right allocation? So on and so forth. But when you get, again, to the tax side of the equation, sometimes I like to look backwards at my clients' taxes, especially those that do it themselves, just to make sure they're taking advantage of every deduction. And I would probably say 3 out of 10 returns I look at, we make modifications to prior years because someone says, TurboTax didn't ask me that question. And that's the reason why between October and November, so important to do those tax reviews. So important to say, do you maximize that TSP or a 401k plan? Have you put as much money into it? Payroll deduction, because we can't write checks to catch up.
So super important to know these things, right? So this podcast is all about action items. So let's talk about little things that you can do before the end of the year to make sure you are on track. Pops, I'm going to say number one, steal your thunder here, but run a tax projection. Use the IRS's website is pretty good. Create your own system if you like, but know what these numbers are so you're not surprised in April.
Micah, if you work with an advisor, sit and talk with the advisor. You may have capital gains from mutual funds being paid that you're not even anticipated in there. And I see that, we have clients that have individual accounts that they're running, I'm going to say TD, but it's now Schwab, and they got all these great mutual funds. I have to look at the historical capital gains. How much dividends are they paying? Because if you get a $10,000 surprise because in this market sell-off, someone has rebalanced a portfolio and it's become a taxable event, that can screw up your tax planning. I like, in my clients, plus or minus $1,000. That's kind of my mental track as I go through that, making sure we have enough paid in that you get a small refund or I owe a little bit. Not huge refunds, although I have some clients that like to save through the IRS.
I love it. Second, last action item I'm going to say is look at your Roth conversions that you should do. I'm a big fan of these. You should look at it every single year. Doesn't mean it makes sense, but look at the numbers. Does it make sense to do a conversion? How are you going to pay for those taxes if you do a Roth conversion? But start increasing that tax-free portion of money for your retirement.
And I like the last area, Micah. It's cash flow. We talk about, put more money in the TSP. Make sure you can afford it. Don't run up a huge credit card debt because you live on credit card for 3 months just to get the tax savings. So it's a balancing act for sure.
I love it. It's 100% a balancing act, things that we got to be focused on, right? So with that, make sure you're taking action with this podcast. Make sure you're doing those things, improving your retirement. Pops, thanks so much for joining us. And until next time, happy planning.